Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsandMarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are in a Friday in Vancouver. It's kind of dull out where I am with a slow drizzle, but it's not. There was a few snowflakes earlier this morning. So.
Get out of here.
Yeah.
Oh, snow in Vancouver. For the rest of Canada, one flake comes down, a city of close to 3 million people just goes into panic mode.
Oh, yeah.
Oh, yeah. They don't know how to drive in it.
Well, the problem is that a lot of the snow in Vancouver is right at the freezing level, and you will find that the snow in Winnipeg or Toronto or Montreal, when it's at the freezing level, is the same as it is in Vancouver. Zero coefficient of friction, just no traction at all. So
slip, slide, yeah.
But anybody who skis in Vancouver knows about snowy roads. So.
Bob, as usual, we have listener questions, so let's dive in. Our first question is from Cecil, and you say...
Oh, yeah, our friend Cecil.
Hi, guys. Great show. I have a question for Bob. I had a conversation with a financial advisor regarding the markets. He's very bullish and said, while markets will be volatile, the direction is up. I asked about high PE values and overextended stocks, but he's downplaying it, saying, as long as interest rates are below 2% like now, it's all good. If rates were 4%, we'd have a different view on stocks. He actually says it's a good time to be more aggressive on stocks, and he's recommending a 70% plus stock portfolio. What say you? Where will interest rates go in a long-term market decline? Do they have to be high before that begins? I thought interest rates rise in a booming economy. Thanks, your friend Cecil. And you say?
Cecil. That's a good question, a good little review. I think the advisor he's talking to could do with more experience. Yeah, and Cecil is right that interest rates, particularly short ones, do go up as the boom ends. And here we get into one of the best ironies possible, is that you go back to 2007 on this one, and of course interest rates, short rates were going up, T-bill rates were going up, and the Fed was following with raising the Fed rate. And I have a wonderful quote from September of 2007, and somebody with a major firm in the States, and he says that the Fed is going to cut rates, that's for sure, and it will drive the markets up. It was a wonderful quote. And at the time, of course, we were writing that if you look at the markets empirically for evidence, you'll find that Treasury bill rates go up during the boom. And in 1929, the T-bill rate went up to 5% in June of that year. And the moment it started down, it was beginning to discount that the boom was over. That the Fed raised the Fed funds to 6% in August, I think it was the middle of August, was just, and I've read about it recently, early in the year, a few of on the board, the Fed were worried about all the crazy speculation, and they wanted to tame it by raising rates, but other people didn't want to raise rates. So then finally they got enough of a quorum together to raise the rates, and it was foolish. So and then the rates went down to, I think the T-bill rate went to 0.08%, and the Fed funds rate down to close to zero. So, but the point is that as Cecil points out, short-dated interest rates go up in the boom and down in the bust. And when they turn down, I've pointed out that they are anticipating the bust, and you get the fastest drop in short rates during the worst part of the bear market. And here you've got, now, because T-bill rates have been so low for so long, they've gone up somewhat. But you're not seeing any of the pundits come out and say, you got to stay along the stock market because Fed's going to cut rates. This ends a quandary. But Cecil mentions that his advisor says you're going to be 70% weighted in stocks. And no, I think the dynamics are each group is so, when it becomes favored and hot, like until Christmas it was banks, and then bang, they got hit. And then now lately it's base metal mining stocks. Woo! Fabulous. And also the oil patch has been terrific. But hey, they're up there now. No, your equity weighting is each investor's call, but the way I'm doing it is just, as each sector becomes very hot, take money off the table, because this is the key, that when the correction or bear market comes in, cash is going to be worth a lot of money. You can buy a lot of stocks at some point. So, no, we wouldn't stay full, I think a 70% weighting is actually kind of heavy. Now, one of the things you can find to look for in a contraction is the, and particularly for Canadians, is you can get maybe a 4-year good grade U.S. corporate bond, and you're not going to get whacked in price because that thing will be redeemed at par. And you're going to get you're going to get much more interest than you would on a deposit or on a T-bill. And then in Canada, the U.S. dollar will likely go up relative to the Canadian, so you get a little bit of comfort out of a rising currency as well. So that's a good place to be. So, and now he asks about where interest rates go in a long-term market decline. Well, T-bill rates go down to zero. Junk bonds go no bid. And actually, yesterday I wrote that in the bond market, you quote bonds as a percent of par, like, 95 price on par, on a par-based bond, or if in your good times, it could be up to 110. And in bad times, it could be down to 20. And in very bad times, if it's a junk bond, it could go, and it fails, it could go no bid at all. So, bonds as a price of par, of course, is parts per 100, pph. And I quipped that the junk bonds could go to parts per million, quote, ppms. But when they get down that bad, there is effectively no bid. So there's the irony. You're going to have T-bill rates going to zero as junk bond rates, junk bond prices just disappear, So there's going to be a lot of money lost in the junk bond side. Now, it's not just, here's an example. On March the 3rd, the rating agencies Moody's and Fitch both took the Russian sovereign debt and marked it down 6 notches to junk. That's exceptional. And but what you get with, say, corporate bonds is that even investment-grade corporate bonds, the company's in trouble in a post-bubble contraction, their bonds are going to turn into junk as well. So, now, then also, he asked about preferreds. I think he did. Did he not? Anyways, even preferred shares, which are better protected than common shares, but they're still a risk instrument. And you can get nailed with preferred shares with the company going into default. As a matter of fact, in the company in default, the bondholders have first rights, and preferred shareholders are down the line. And, of course, equity shareholders are not protected at all. So you pays your money and you takes your chances.
Question from John. After the post-bubble contraction occurs, where would one invest for a good return for retirement income? I assume the general market will be flat and sideways post-bubble. Just wondering about dividends being safe or cut. What historically happens? And one more question. I assume one should wait until the correction before investing.
Yeah, John, you got it. On where one should be for retirement. I mean, that's the stuff you got to protect. So, as I always say, gold itself, by way of coin or barge, is in portfolio insurance. And then the other is, a post-bubble bear market's going to hit everything, and so minimal equities. And I just mentioned on the other question that for Canadians or those outside the U.S. buying, or in the U.S. too, buying a 3 to 4 year term good grade corporate bond will give you a better return without too much risk, and you'll have the satisfaction of getting your money back plus some interest on that. And then dividends. And there's an old saying in the stock market, is when you see the financial crisis, which appears to be developing, the old quip was, the next sound you hear will be the sound of dividends being cut. Because that's what happens. Once the contraction starts, commodity prices head south big time, and that reflects, producer prices, corporations, business, losing pricing power. And when you can't get the prices you need, you start losing money. So then you have trouble covering interest payments, and you have trouble covering dividend payments. And that's the way the business cycle works. Again, in the old days, the stock market would get excited and set a high on a certain month, and then typically the economy would keep going, so that the stock market led the top in the business cycle, by typically 10 to 12 months. And this is where the authorities, in creating what they call the leading indicators, they include the S&P in that, but they don't know the research. And that is that when you're in a great financial mania, of which we're in, when the stock market rolls over, essentially the economy rolls with it as well, because the financial markets have become so dominant in everything. And examples are, 2007 was a fabulous bull market, but it wasn't quite a classic bubble. There were a few items missing, but nonetheless there was enough technical signals at the top to call the top of that one. And but the high for the S&P, I think, was the middle of October, and then in December, Greg Mankiw, a highly regarded Keynesian economist at Harvard, said that nothing could go wrong. And the reason why nothing could go wrong was because the Fed had a dream team of economists. And ironically, later on, the National Bureau of Economic Research, which is the semi-official body that keeps track of the business cycle, said that recession, and it was the worst since the 1930s, that recession started that December. So then you go back to 1929, and Moody, the guy who started Moody's, in a lengthy article published in the Atlantic Monthly, he pointed out that the stock market was golden. Nothing could go wrong because the U.S. had the Federal Reserve System, and it was scientific. That was the term he used, scientific, so nothing could go wrong. And then you had the stock market peaked in that fateful September, and that business cycle started, contraction started in August. The best was in August. So then you go back to the 1873 bubble, which was a big one, and the New York newspaper, I can't remember what it was called, the Herald, it editorialized that while the stock market was up, nothing could go wrong. And the reason why nothing could go wrong was because the U.S. did not have a central bank. So with the Treasury, and not on a gold standard, the Treasury could issue any amounts of currency and credit, and that would prevent things from going bad. Well, the stock market peaked again. That was a September peak, and the recession started that October. And in England, when then the senior economy, in England, the head editor for The Economist, Walter Bagehot, he had just published a book that year saying that nothing can go wrong because the Bank of England had plenty of talent, and all you did was ease credit, and you wouldn't get a credit contraction, so nothing could go wrong. Well, the recession was so lengthy and business conditions so weak that in 1880, a senior economist in England began calling it the Great Depression. And the Great Depression lasted till 1895. So here we are. You're going to have, if this market gets a little more nervous, I think we're going to have some relief here for a while. Credit spreads can seasonally narrow into May. You've had a huge whack to the market. You've had one of the most straight-up markets in commodities in history, and so you've got wild markets out there, but the hit has done a lot of damage. Russia has now, with the sanctions on, is now more than likely in a contraction, in which case it's joining China, which is already in its post-bubble contraction. The only thing that has yet to happen is a serious contraction has yet to be discovered in London or in New York. But hey, commodities don't go up forever, and but our guess now is that after mid-year, most of the favorable seasonals for credit spreads for some commodities and for the stock market are kind of over. You know, it's the old buy in October and sell in May and go away. So there's plenty of risk out there, and there's plenty of evidence in the past, as I say, 2007, 1929, and 1873, where the street was convinced that nothing can go wrong. And that's where the street was in December. And all of a sudden, yeah, you can say they got a whole lot of bad news coming out of Ukraine, but here's the other hand, Jim, with the restrictions and being put on against Russia. That's not a one-way highway, you know. If you're shutting down somebody else's economy, there's a road coming back, 2 lanes coming back at you that's going to be slowing trade as well. So these authorities are shooting themselves in the foot. So, but just look at it simply. Russia is probably now in a recession.
Russia's richest businessman tells Putin, don't take us back to 1917, the year of the Russian Revolution. Vladimir Potanin, he's the president of metals giant Norilsk Nickel, told Putin if you nationalize companies like McDonald's or Starbucks that are pulling out of Russia right now or shutting down operations, nobody will want to invest in Russia for the next 2 or 3 decades because they won't trust you again. And look what that did. You know, people were starving in the streets because of it.
Well, these oligarchs who were able to assemble vast amounts of wealth. They're very sharp guys. And Putin himself became an oligarch. He's got some huge yacht that was then put away somewhere so the authorities couldn't seize it. And this is a very now a very evil man. And no, the damage has been done. I would say that Russia is probably in a recession. as is China. And the only thing that has yet to happen on the bubble year is that it hasn't hit the U.S. But then, as I discussed earlier, the economy continues to look good so long as the stock market is going up. And then when the stock market really does reverse and is in a contraction, the economy will be contracting as well. So that's what's ahead of us. Now, the hit to the U.S. stock market has been news-driven, and that's important itself, because hitherto, in a great bull market, bad news doesn't hit the market, whereas this thing, it became vulnerable to bad news. So, Jim, these are the most fascinating times. I'm absolutely find every day interesting.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, President Biden has turned to adversaries like Iran and Venezuela to boost world oil supplies to bring down gasoline prices instead of turning to allies like Canada to boost production. What's the deal there?
Well, they hate the middle classes in both Canada and the U.S. And of course, Prime Minister Trudeau is there as well. He would be happy as hell to shut down all oil and gas production in Canada. So the moment Biden announced they were shutting down the Keystone pipeline and then making sure that nothing was going on, well, he tried to shut down oil and gas production wherever he could. And the price of crude oil turned on a dime right then and there, and it's been going up ever since. So, but you have to really hate the people to consider continuing to get oil from Russia, of which, I don't know, I heard something about 300,000 barrels a day equivalent. But then you've got the people in the eastern seaboard. In Quebec, they've been taught to hate pipelines, so then they then have the risk of tankers sailing up the pristine waters of the St. Lawrence. And then in Maine, they've been taught to hate pipelines, so they then are facing tankers of oil heading their coasts, which of course don't happen. But I think that a little more practical in the White House, they would realize that it's a hell of a good idea to open up the taps in Canada and in the United States. There's huge reserves of oil and gas. But here's the one that's really as evil as well, is that Quebec gets, $10 billion a year out of equalization taxes, and a good portion of that comes from the oil-producing provinces. And yet they will not, I think there already is a small pipeline into Montreal, but they refuse to have it expanded. This is idiocy beyond imagination. But I'm thinking that the hit to Europe, and in Germany I'm reading that they're going to be expanding coal production. And of course one idiot is saying that, we now need more windmills and more solar. But I think that they will end up not shutting down nuclear. And I think in England they can turn to, because there's a whole of the huge amounts of oil and gas yet to be found in England, or just yet in the North Sea, because Norway is still a huge producer of petroleum products. So, Jim, I'm going to call for a new bull market in common sense, because most people now are seeing that the experts in power really are venal. They're acting on their own personal idiosyncrasies, and it's just plain stupid stuff. And I think it could change in here. A while ago, Trudeau government bought Trans-Canada pipelines, for God's sake, while they're trying to destroy it. But I think construction of the expansion and pipeline capacity has continued. But man, for ordinary people, if you just stop and get rid of your passions and look at what these things are doing, like Biden is now trying to get oil out of Iran and oil out of Venezuela, and there's nobody in Venezuela that can run the oil business. This is where Venezuela's been having to import gasoline, for gosh sake. So, no, I think many, many ordinary people are going to look at this and look at the high price they're paying at the pumps and say, hey, get with it. And I think in a few months' time, even the Trudeau government can say, let's go back to work and start producing this good stuff.
I urge our listeners to listen to the interview I did with Joseph Schachter, the publisher of the Schachter Energy Report out of Calgary. He's saying by the third quarter, he expects oil prices to be down to $48 to $58 a barrel because Iran and Venezuela will finally be online.
Yeah, also it's been a wonderful straight-up surge of speculation, and the crude oil is generating technical excesses. They're not quite to where they were in June of 2007. My gosh, I remember that when Ross was doing the charts. In the third week of June in 2007, we had upside exhaustions on the weekly and on the daily, and I wrote that that's enough to call for a cyclical bear market in crude. And I wrote, if the monthly comes in, like at the end of June, then that would call for a secular bear market in crude. Well, we did get both a cyclical and a secular bear market in crude, and the same indicators are becoming excessive, but not quite as much as they were in June of 2007. But if they get that far, then we could make the call for certainly a cyclical bear market for crude oil. And we also worth noting that base metal prices are generating excesses. The base metal mining stocks are way up there, and we cover those all the time. And the index is the XMB, and it has had a fabulous rally and getting overbought. So there's a lot of good action in there, and with our technical signs getting overbought, we should be able to make the call. Also, gold and the gold stocks had a good rally, and again are overbought. So now we're going to go back here and pat ourselves on the shoulder here. In the January hit, things got oversold, and I looked around and I thought, what seasonal are we going to try and find a way to of looking at a seasonal in the base metals that would suggest something positive. And of course, you know that copper often has a seasonal high in March, and I thought, well, maybe the other commodity base metals would rally with it, and of course it has. And then you run into this short in nickel that is huge, and so yeah, base metals were likely to rally into March, and they have big time. So then you're not sure exactly how many more weeks it can run, but they've had some sharp whacks. So this is where I think that after mid-year, a lot of these things can head south. So Schachter and his call at some time for maybe $48 or $50 crude, yeah, it's just the only thing is the path of how you go from here to there. And I'll go back to last summer when Ross had, in his long-term chart, he had a high for crude oil for 103. And I said to Ross, oh, that's too high. But then we got up to, I guess, 130 or something like that. So, but the main thing, very overdone, and sometimes it takes a number of weeks for these things to roll over.
Headline: Investors fret over default protection for Russian bonds. Russia's foreign debt is about $480 billion.
Oh yeah, and as I said, their sovereign debt, they did a 6-notch downgrade to junk. I mean, that is just terrible, because what happens there is that many pension funds and casualty insurers, now people like that, they got rules that they can't own junk. So they only can own investment grade, and therefore they got to be sellers. And it's a disaster. Years ago, in Canada, it was the Dominion Bond Rating Agency. I knew one of the guys there, and we would talk occasionally, and I know one of the things I asked him, and I said, now maybe it was in a bad market, and I said, now some of these corporate bonds, they're already junk, but you guys are not downgrading them. He says, yep, Bob, he says, we really are reluctant to take the final step down to a junk rating, because it then causes the bond to trade as a junk. So then to take a sovereign issue and 6-notch it down to junk that's really something.
Headline, China Construction Bank gets reprieve on metals margin calls. And it's all connected to the Chinese tycoon behind the big naked short on nickel, worth $6 to $8 billion.
Yeah, it's a big number, and it's so big that they've got to accommodate the guy. But Jim, in 1985, I think it was, the base metal prices were strong, and there was then the Tin Council, they called it, but you could call it the Tin Cartel, which were mainly the companies that had the main production of tin. And they decided to squeeze the shorts, and it became a runaway market. I can't remember any of the prices or something like that, but it was a monumental short squeeze. And when it finally broke, maybe September, October of that year, there were the London Metal Exchange management were highly stressed, and there were a couple of trading firms went broke on it. So then we used that, and because the Tin Cartel Council was highly regarded, and said if the Tin Council fails, what about OPEC? So the price of crude went up to, I think it was early November when the announcement and the failures and the climax to the tin problem on the London Metal Exchange. And then we used that to point out that crude oil was getting overbought, and that the regard for OPEC's powers and integrity might become under question. And I think the high was 31 in late November, and in that following April it was down into the $9 level. So these squeezes in metal prices have consequences when they finally burn out. So this is where let's look at commodities. Lumber can set a seasonal high in June fairly reliably. Copper can set a high in March, which it has done, and then a secondary high in July. And then copper can set a seasonal low in November. Lumber can set a seasonal low in October. And crude oil can set a seasonal low in January, February, which it did not do this year. So here we go. A huge, probably an unprecedentedly severe squeeze in nickel and the other metals. But nickel's the highlight one, and there you go. So I think you're going to have very weak commodity prices after mid-year.
Bob, thank you so much for your insight.
Well, there we go, Jim. Things just seem to flow along today. We had some very well considered questions, and we've got one of the most fascinating markets in history.
And there's this Chinese curse: may you live in interesting times.
Yeah.
For people like us, we like interesting times.
Yeah. But there's a subtlety in there that I love.
Yes.
Just lovely. Your interesting times will be desperation and trying to stay solvent. Yeah.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He was speaking to us from Vancouver. If you have any questions for Bob, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.